So I want to give props to Zach over there. Thanks for putting this together, and I'm very appreciative to him and to anybody who's in the audience. It's a very strange medium, so I'm talking. I don't see anybody there, and there's no audio. So if people have questions, I assume there's a computer there that you're messaging me on. You can load them up in the question section. I will try to answer everything at the end. And if I tend to veer off point, or you want to sort of refocus me, please feel free to message me. Again, I don't necessarily hear anybody there, so it's a little bit strange. I feel like I'm talking to myself. So I'm the author of Trade Streaming Related Profits, Building a Killer Portfolio in the Age of Social Media. And I coined this term trade streaming. And it's less about the media, and it's more about what the media has actually changed in terms of our investing. So the two things I see the most change is that we've entered a new age of transparency. Not only with data, but also with sort of analysis as well, and participation. People are sharing this stuff. We'll talk about that more. So a little bit about me. And it's not changing. Hold on. Hello. There we go. About me. So I'm sort of focused on the intersection of investing, media, and technology. We're definitely seeing convergence right now. I'm a professional financial advisor by day, although I'm sort of scaling out of that. I previously was an analyst for a multinational hedge fund, which is sort of where I cut my teeth. And I was investing early on in sort of new media, right? So it wasn't necessarily some of the stuff I'll be talking about today, but it was the Yahoos and Googles of this world. And I was actually one of the founding team of Seeking Alpha. I ran business development for them, so I was instrumental in sort of getting those initial deals done where we syndicated out Seeking Alpha content, which really was a big deal at the time. I don't want to toot my own horn, but Seeking Alpha really was seen as sort of the Wild West, sort of these bloggers, in their underwear writing about stocks. And we sat, with the management team at the Wall Street Journal. We didn't even have business cards, and we were sort of telling them that, we had this fine editorial layer. I assume everybody knows what Seeking Alpha is by now. That we were sort of their compatriot in the blogosphere. I mentioned Covestra on there. It's a company I talk about in the book, and also a company I'm doing some consulting for right now. That's a little bit about me. I can tell you more. I live in Israel. I have 5 kids. I used to play football, which is why I had this slide in the beginning. Okay, so evolution of investing. And again, this is my opinion. 1980s was the era of sort of the stock analyst pump. There was a lot of authority and leverage in the Wall Street analyst call. We know how that ended up. Post that, we sort of saw the individual as a stock picker. This is when the E-Trades were first getting on, and people were there were commercials about becoming a self-made millionaire at home, just trading your own account. There was sort of an autonomy that the individual investors began to feel. That didn't end very well as well. 2000, we sort of saw was the Jack Bogle era. So sort of this buy and hold idea. I can't say it necessarily failed, but I deal with retirement clients, right, that have seen their portfolios go nowhere in the past decade, and I don't think that actually was a good thing for them. 2010. I'm tooting my own horn. It's about trade streaming. It's about sort of, and we'll get into this more. It's about mimicking people and strategies that are smarter than you. It's leveraging that transparency that I talked about, that social media sort of greases in the market, and implementing strategies that have been proven to work. It's part buy and hold. It's also part stock picker, but it's getting beyond the again, this may sound like heresy to you guys, but I always wanted to come with the original stock pick and show that I was the smartest guy in the room. In my individual practice and in my professional life, working with clients, I've moved out of trying to pick individual stocks. Instead, I'm doing what I call piggybacking, so sort of creating a smart portfolio of some of the hedge funds, some of the the top gurus in the hedge fund industry. Now, I'm not picking those at random. There's some rigor to that, and we'll talk about that as we go on. But that's sort of what I'm doing in my own life now. So then, previously, the investment environment was one of scarcity, right? So it was an old boys network, sort of the the crux of knowledge and dissemination came from, top-down model from Wall Street. And so, if you wanted in, you had to buy into that network. Now we're sort of seeing just a confluence of lots of things going on. Information is no longer in scarcity. We probably have too much information right now. And what that has done is empower the individual investor. But with that power comes a responsibility that you need to make decisions for yourself. And I think some of the older generation doesn't necessarily understand that quite yet. But that's sort of what I've seen change. So how do we make better investing decisions? And again, and this is the TradeStreaming motto: imitation is still the best form of flattery. So I've gotten beyond trying to outsmart the market. Instead, in some way, I'm outsourcing some of that far-reaching attempt. I'm outsourcing to people that I know are smarter than me and have a better long-term track record to me. So TradeStreaming in a nutshell is all about tapping the right people willing to share the most valuable information, right? So some of those may reside in the blogosphere, some of those may be, in Stamford, Connecticut, that you can't necessarily pick up the phone and call. Some of them may be on Twitter, and they're tweeting through StockTwits, and I don't know how many of you saw that StockTwits signed a deal this week with CNN Money. So we're sort of seeing the emergence of the blogosphere, the tweetosphere as well, sort of partner with mainstream media. Part of the process of TradeStreaming is identifying those people, and then the next step is being able to plug into what other TradeStream, their ongoing flow of data, of information that these people are publishing online, whether they're doing it themselves or whether it's sort of just data-driven. So a little bit about what's going on in the TradeStreaming workflow. So you have the mainstream media. That's sort of like on the left-hand side of that slide. I hope everybody's able to see the slides and see me transpire through them. So left-hand side, we've got Yahoo Finance, Wall Street Journal. They're still important, right? And TradeStreaming is not about minimizing those. What's happening is because mainstream media is really still much better at breaking stories, the blogosphere and people tweeting and the participation media is much better at the analysis stage. Because a lot of these people have skin in the game. The people who are analyzing stuff, they're actually trading the stuff they're talking about, which is not allowed in mainstream media, right? So if you go to somebody at Dow Jones, I believe the Dow Jones journalistic policy is that, at most they're allowed to own a passive fund or an ETF. They're not allowed to pick stocks, and so they really don't have experience trading these things. So that's why the blogosphere and sort of the second generation, online analysts is so powerful. So what basically the mainstream media is then feeding sort of the blogosphere with idea generation. They're breaking a story about something. The blogosphere then sort of puts it in a blender, figures out what it means, and then republishes it back for everybody to share. And we've now seen sort of the full loop, the full circle, where mainstream media, and I know on my blog and my writing, I've got lots of Barron's and Wall Street Journal journalists following what I'm writing. They may not actually give me an attribution in their article. And in fact, at one point, there was a Barron's article that was almost stock and barrel what I had written. But it's happening, right? So they're being influenced by us, and they're influencing us, and that's sort of the ongoing sort of flow. So in the book, I talk about 8 different strategies, and I'm gonna go through them quickly now. If people have questions about the individual strategies, I'm happy to answer them at the end. By the way, I had slotted about an hour for this. I'll finish before an hour. If people have questions, we can round it off till there. So the first strategy, and this is probably the least rigorous strategy, is sort of ride the long tail. The long tail of financial content is the content being produced in the blogosphere 24 hours a day, 7 days a week. Some of it is really crappy, and some of it is really, really valuable. So you have to, what we're going to see as time goes on is the emergence of better filtering tools to be able to figure out who that is, who is producing that good content. And sometimes you can judge it by performance, and sometimes it's more about idea generation, right? So even if somebody's wrong, I do believe that there's value in a thesis about a stock or an investment thesis that doesn't necessarily pan out, as long as there's some rigor to the argument. The second strategy I talk about is in the book. Each one of these is an entire chapter. I talk about piggybacking the pros. That's the construction of an all-star portfolio of best hedge fund stock picks. I heard from the CEO of AlphaClone, whom I did a webinar last night. I hope some of you guys joined us. That I think UCLA, the business school, had done some type of case study on AlphaClone. I don't know if that's true, but that is an instrumental tool, I think, in being able to implement some of these ideas, and I'm using them personally. And I think that, what gets misconstrued in the media is sort of the idea of just, willy-nilly picking ideas that hedge fund managers do, and we all do that to some extent. But you can actually create, a really rigorous portfolio a rules-based portfolio that follows some of their picks. So maybe it's, the best pick, of Stevie Cohen, or the top 3 picks of Stevie Cohen perform best long-term, while maybe the newest pick of somebody like Eddie Lambert works out better. I'm just making that up. And you can put together sort of this all-star portfolio, and I think that's really interesting. Next is communing with experts. So you have the rise of expert networks, right? So I don't know how many of you are registered at SumZero or in, the Value Investing Club. Covestor is also another one of these types of communities, basically where it could be an open community, it could be a sort of closed community where there's some type of admission process, but it's a bunch of smart people kind of sharing ideas. And if there is a mechanism with which to judge their performance or their authority, sometimes it's performance, sometimes it's authority, sometimes it's a mixture of the two, you'll get to bubble up some of the smarter people within the network, and most of those networks then would allow you to sort of follow and plug into that person's trade stream. Seeing the same thing even on a Quora or something, which is a Q&A platform. You can sort of isolate who are the smart people that you want to listen to and turn down the volume on everybody else. The fourth, and we're starting to see this a little bit, and this is crowdsourcing investment ideas. There was a site called Pick'em. I think it was created out on the West Coast. PIQQEM, and that provided some type of gaming mechanism where some people could rate stocks and vote one up or down, and basically even break it out towards demographic information. So, if you wanted to know the, what I don't know, cardiac surgeons were buying in Los Angeles, and how they were ranking some of these things, you could figure that out. There hasn't been widespread adoption of that. I think that, and we'll talk about this a little bit more in what I talk about in collateral research number 8, but there's I guess, better ways to crowdsource information. And one of the questions people always ask about crowdsourcing isn't the stock market itself sort of, if you believe in the efficient market hypothesis, sort of doesn't that embed a lot of, basically everybody's opinion already, and we could talk about that. Screening 2.0, number 5. I think one of the main companies doing a great job in this is Validia, which is John Reese's company. He wrote a book that I have here on my bookshelf called The Guru Investor, where he basically, through technology, through algorithms, a smart guy, recreated sort of stock screens that would fit the investing criteria of some of the world's best, like so Peter Lynch or Warren Buffett, and basically uses that to pick stocks, and those filters, those screens have done extremely well. So it's sort of recreating history's best investors, and then being able to, even though the people are not necessarily working anymore, being able to sort of build portfolios around their methodologies, and that seems to work really well. One thing I will say about that strategy is that as John Reese has been monitoring these things for almost, I think, 10 years now, without fail, each one of those strategies seems to underperform for a period of 1 to 3 years. But without fail, and I think without exception, regains all the losses and makes and more within that 5-year period. So it's very important with all these things that if you have a rules-based thing, that you stick with the strategy. Even sticking with a strategy that temporarily underperforms is better than not having a strategy. Number 6, tracking inside moves, and this is something I'm doing in my individual investing, and I think is getting more and more popular as we're seeing bloggers sort of focus on this information. You have different types of insiders, right? So you have corporate executives who can buy their own stock, and what's good here is you want to look for a signal, right? So we want to see how, we want to see insiders putting their own money to work, buying their own company stock, and there's another book here on the shelf somewhere. I'm blanking on the name. I have it on the blog. I can send the link out later, but he's a professor at the University of Michigan who wrote a book on insider trading. And we're talking about the legal type of insider trading. There's a whole other field of knowledge that tries to bubble up illegal insider trade. But we're talking about non-options expensing and basically a CFO of a company reaching into his pocket and putting his own money to work and buying the stock. And it works better in small to mid-sized companies. It works better when you have clustering, when you have multiple insiders buying their own company stock. And that's a very powerful tool. There's even an ETF now that tracks this stuff. It's one of the Claymore, which is now got bought by Guggenheim. It's an index provided by a company called Sabrience, which is a California company, and it tracks insider buying, has some type of methodology. And I think the ticker is NFO. Vastly outperformed the S&P since it's been out. I think it's been out since 2008, 2007. Not sure. Next one, grind the rumor mill, right? Decipher what's true to make money on the news. I don't know how good or a practical strategy this is, but there's been some studies that obviously we all like to buy stocks that go up, and a company that's a target of an acquisition typically sees an increase in its price. That's been well documented throughout history. What's also known is the vast majority of those rumors don't necessarily come to fruition. So you can actually create with rigor, you can create a strategy that sort of basically shorts a basket of those stocks against the market. And that's a good performing strategy going further. So that's basically taking the other side of the trade on rumors, that rumors aren't necessarily actualized, and that ultimately, the few that do actually get actualized are drowned out by the rest that don't. And 8, and I think this is something that I'd love to hear your opinion on as MBAs. Collateral research, and this is what I talk about a lot, and it's sort of this ambiguous, or it's everything else. It's all this information that's non-financial in nature, but that can be a very useful input into the investment process. So I'll give you an example. There's a professor at UNC, I believe, in the business school there, Joey Engelberg, who just co-authored a paper. And by the way, I interview a lot of these people on my podcast, so if you're interested in hearing their insights and stuff like that, it's on iTunes. You can definitely plug in. It's free. Professor Engelberg found that there was some, basically using Google search data. Right? Google search data he used as a approximate of investor attention. We know that stocks that have more investor attention, however you define investor attention, typically do better than the ones that don't. We've looked at other ways to define attention throughout history. That could be, how much money they're spending on their investor relations strategy, how much media press, how many times they're written up in the Wall Street Journal. He used Google searches, right? So as people are turning to Google as the way that they interface with the web, basically he used that as an approximate, and that strategy outperformed. So you would basically go along the stocks that see a certain type of delta in their interest. He talked about that there, and I wrote it up on my site. I'm actually managing my own portfolio. It's not a hedge fund. It's a managed account that I have with some clients that I call a guru portfolio. It looks at 2,500 global funds, and so I incubated this in-house. I used AlphaClone to do it. We have real money behind it, so I just wanted to use it as a sort of as a illustrative of what I'm talking about. Of the 2,500, I looked at sort of the best performing managers in different industries, different strategies, and geographies. So what I didn't include was sort of like the Renaissance technologies that are like sort of just trading shops. I looked at people that are funds that took big positions in companies and held them for a period of time. One may be a biotech investor, another one may be a high tech investor, and so I sort of I picked different managers to actually represent different allocations to different industries and stuff. And again, I looked for people with concentrated portfolios. And what I did at the portfolio level, I figured out each one of those managers has a different strategy associated with it. So there was a Harvard study by Polk a couple years ago called Best Ideas, and that found that if you looked at and this is the mutual fund industry, if you looked at the mutual fund industry and wanted to approximate their performance by just buying the stock that they have the most conviction in, like the largest holding, came pretty close to actually approximating the performance of the entire fund. So there's some hedge funds actually that perform best that way. Sometimes it's the best new idea, right? So that when somebody puts in a new idea into the portfolio, sometimes if you just bought that idea, even if the hedge fund is still in sort of an accumulation phase of that, and it's a very small position, that may end up performing better than other ones. There's also a popularity one, which cuts across different hedge funds, right? So I'll tell you, a great strategy long-term is to buy the most popular tech stock. That's one of the best strategies, actually, on AlphaClone that I found. Obviously now it's Apple, but that vastly outperformed by thousands of basis points over the long term the stock market. And then what I do is I window that down to about 8 to 12 positions and I rebalance that quarterly. So there's some trading involved, and that may incur at a client's expense. But typically, you know, we don't. It's not 100% turnover because hedge funds are not necessarily turning over these things every quarter, but it's probably close to 50% or so. And I just put up, well, the numbers aren't actually. This is year-to-date 2011 up until March, and the numbers still look pretty good. But you look at the clone, I don't know if you can tell very well, but you've got the year here. You've got the clone, which is my portfolio. So I only started testing midway through 2008. So these are back-tested results. You have the S&P here, whoa, and then you have the plus and minus here of how well the clone outperformed the S&P 500. So again, when you create something with back-tested results, you know, it's always, everything always looks better in the rearview mirror. You can create a strategy that actually maximizes that won't do that going forward. So always be wary of that. But I've had real money behind this. It's a good strategy. Clients tend to like it because they like the idea of, you know, sort of mimicking the moves of some of the, you know, some famed investors. And so that's that. Let me see, it's a little locked up here. Give me a sec. Oh, what's going on here? Okay. So one more. You can buy my book. I know that's actually, I met Zach. I saw he was discussing the book on Twitter, and I sort of reached out to him. So I'm always happy to have feedback, and you know, the book does make for a doorstop or kindling if you ever get cold. TradeStreaming.com, I'm talking about a lot of this stuff. I've got a podcast. I'm doing ongoing webinars right now. So I'm trying to provide access to some of the thought leaders in the space and just kind of being, you know, sort of involved in a lot of different things. I'm on Twitter at New Rules Invest. I'm always happy to talk to people and share ideas and explain things. And so I hope that was useful for you guys. That ends the show. I don't know if you have any questions or feedback. Let's see what we got here. Great. So you guys are going to open it up for questions. Do we have any questions? Is there anybody out there? Yeah. Ooh. Is it possible to unmute? I think I can unmute you. Quite sure how. I think you actually have to be a co-presenter. Let me see if I can do that. I don't see how to be able to do that. I'm sorry. The question was, am I familiar with John Boland's paper on Twitter mood predicting the stock market? I'm a little bit familiar about it. Actually, I was interviewed by he's a Belgian professor. I think he's at Indiana University. I got interviewed in Flemish about this. So basically, he was researching Twitter mood, and basically his thesis before he started out, and I guess I don't know if that's academically honest, but he actually had a thesis before he started the research, was that if the stock market performed poorly, we would then see a reflection of that in the sentiment. And there's all types of sentiment analysis that's going on right now through unstructured text. Would we see sort of a concomitant downturn in feeling sentiment online in the Twitter sphere? And what he actually found was the inverse, right? So if people were particularly positive or negative before the stock market opened, I think there was a trailing period, it impacted the stock market. And it was just sort of like the initial paper that said, wow, this actually, there is a connection, there's a correlation. There's not really a trading strategy around that yet, but I know Ballin's been hired by a couple of hedge funds, and I think he's working to create that strategy. So I believe in Elliott wave theory. I don't know enough about Elliott wave theory to comment on that. I'm familiar with it, but I don't know. People swear by it. Any other questions? The Aaron taking control over there. Has one strategy worked better than the rest? Of the 8 strategies I talk about, or hedge fund cloning? Can you be more specific on the question? Of the 8, right? So some of the strategies. Let me go back to the strategies here. So ride the long tail, right? And in the book, I try to create a strategy around that. That's really useful. Just looking for information, right? Can you create a rigorous strategy around that? There was actually a paper, I recommend you check it out, at Purdue University. They mentioned it on Seeking Alpha. Found a way to sort of crowdsource ideas from Seeking Alpha, and they found that it really vastly outperformed the stock market or something like that. I'm not quite sure the ins and outs of how that worked, but that seems to be a winning strategy. Again, all this is sort of back-tested, so it's hard to see how this stuff is going to perform going forward. The one I think that's most readily available and actionable is the Piggyback the Pros strategy. That's something you can actually implement and seems tenable for a lot of people. You can create all kinds of strategies there, and if you guys are following Market Folly, which is sort of this blogger who's a hedge fund guy in Texas who sort of reviews 13F filings and stuff like that. So he's got strategies on there as well. And you can. I think that's quite interesting. There's other strategies here that I didn't talk about. I don't know if you guys are following like Med Faber stuff. He's out. I think he's in LA. He did the sort of like global tactical asset allocation. He just launched an ETF, GTAA. I'm not giving any recommendations, but this is the idea of just sort of asset allocation, like broad-based asset allocation being diversified, but using a timing mechanism, a momentum mechanism to hedge your downside. And that's he wrote one of the most downloaded papers on some of the academic networks, and they just launched a security to basically implement some of those ideas. These ideas all work, right? Communicating with experts, right? So you can, this idea of like going onto a Covestor or a Wealthfront and sort of finding a next generation or sort of up-and-coming manager that hasn't been found yet. Again, there's not necessarily rigor behind that, but we know that as managers get bigger and they attract more and more money, the returns go down. That's just the way the mathematics work. So you can find some of these guys who are vastly outperforming. I mean, you can even go for like a currency, CURRENSEE, which is a trading network for Forex. So if you enjoy gambling, there's guys on there that are returning, I don't know, thousands of % a year, and they're doing it for years, right? So you can actually auto-trade these guys and just hook up your account and they can trade your money. So will that continue to work? I have no idea. I think crowdsourcing ideas and collateral research in the future will have a lot, there's going to be a lot of information there. I think we're finding more and more correlation. I mean, even think about it. I mean, like I'll give you an example. I talk about this in the book. We took a big position in a company called Gateway Computer. I don't know if the company's around now. Very poorly run company for years. Had a lot of cash on the books. You'd mention to people and their eyes would roll into the back of their head. We did a lot of work on it. We spoke to the people on the floor at Best Buy, and they had actually bought a company called eMachines. This was years ago before Apple sort of really hit its stride. eMachines, essentially backed into Gateway using all the cash in Gateway's balance sheet. It was low cost. Instead of doing direct, it was had a retail presence, and it was a way for Gateway basically to expand its distribution through Best Buy. And within a few months, is our largest position. We made 35%, and the idea there was basically we could get information in a variety of different ways. We were using Gerson Lehrman, right? We were talking to people and experts on the floor, trying to get an idea of what was going on, all building the thesis. All these things were additive throughout the process. I don't know if that answers the question. Insider moves, right? So there's this NFO. Look at the Sabrient index that uses these things. I have a screen, and there are a couple sites online, like J3SG, you know, or Guru Focus, where you can, or Street Insider, that whether for free or a premium subscription, you can get a list of who's buying what on a daily basis. And again, there is some rigor behind that. If I would recommend reading Inside Information by Professor John, I think it is, which you want to look for small to mid-sized companies. You want to see multiple investors buying all at the same time. You want to see significant positions, right? You don't want to see them buying 1,000 shares. You want to see them putting up something above, $75,000 to $100,000 worth at each purchase. And that's a great way. They have a lot better insight into their business than I have. What are some of the best tools to use? You mentioned AlphaClone. What else do I recommend? It sort of depends. I mean, I talk about a lot of them on TradeStreaming. I tried to mention some of them now. The Validia is a really great tool if you're looking to sort of first screener. FinViz is one that I mentioned, and occasionally I have lists of these on my site, the best tools to for stock screeners. FinViz, F-I-N-V-I-Z. I'm sure some of you use it. Very good screener, very robust screener. And the idea of screening 2.0 is not just looking. I mean, part of the problem with screening is most people don't necessarily know what to screen for. So you can program some of the stuff to screen for specifically certain strategies and stuff like that. The American, I don't know, the AAII, whatever that stands for, individual investors, they have some fantastic screens. I think it costs like $100 a year or something to subscribe to. Their screens do fantastic. There's another company that recently started, and this is interesting, it's called Empirical Finance. Basically what they tried to do, and I think they raised a fund around it, is they take cutting-edge academic research and then invest in it, and they write up a lot of things. They created some free screeners that, sort of recreate Piotrowski, F-Score, Joel Greenblatt. The truth is, I believe, and I wrote about the magic formula, and it sounds crazy, but the thing works. And so magicformula.com, if you go to that, it's all free, and you can screen for magic formula stuff that ranks. That, again, it's all about sticking with a strategy. Maybe the one about hedge fund leaks. Can you comment further on the fact that many hedge funds are strategically leaking their trades after already built a significant position? So this is the idea, and I'm not qualified to answer it. I mean, you'd probably want to address that to AlphaClone, to Maz Jadala over there. But there's a couple questions or a couple stumbling blocks that people find when they talk about this replication strategy, right? Because to replicate a hedge fund, you're using their publicly disclosed filings, right? So there's a lag, and it is possible that a hedge fund is amassing a position and then starts touting it in the media. There are a few guys out there, I'm not going to name names, that are on CNBC talking about their positions, and then they bail out. But the truth is, I don't think it matters. I'm just looking at the data, and the data sort of accounts for that. The truth is, and we spoke about this on the webinar last night, most hedge funds, they have the reputation of sort of blowing out of stuff very quickly. The average hedge fund holding is about a year, and that was a Goldman Sachs number, and AlphaClone sort of corroborated that. So typically, if you want to do the strategy, you want to follow funds that actually take larger positions and stuff. I don't know if that answers the question fully. Can you further comment on the fact that many hedge funds, just read that one. Are there any other questions there? Did I miss one? One sec. Just waiting for another question here. So the question is, are there ways to get constructs of what hedge funds have other than looking through SEC filings? You can do what they're talking about publicly, but most hedge funds aren't necessarily talking about it. Most hedge funds are actually very secretive about what they own. That's really the best way. And again, even the filings, the SEC filings, miss out on certain things. It misses out on their shorts. It misses out on certain options. Any synthetic stuff that they own doesn't necessarily get included in that. And again, that doesn't really matter. AlphaClone did a study of basically using the clone and trying to approximate real returns. And you know, because a lot of people say the alpha that the hedge funds create is all in their shorts. It doesn't typically work that way. The vast majority, the clone comes very close to approximating the real performance of the fund. So the answer is no. Ooh, hedge fund managers I admire most. I don't necessarily want to name names, but you know, I love I'm putting on the spot, but like Baupost, Klarman there, I think he's a fantastic investor. He said something very telling in the 2008. I guess they reproduced security analysis, Benjamin Graham's book, and he said something like the tenets of value investing, you know, existed in 1934 whenever he wrote the book first, and you know, it's been there ever since. And you know, all you have to do is really just pick it up because it still works. And the hardest thing about doing some of these things, and I'll tell you, investing, you know, piggybacking the pros, I get a portfolio that, in fact, it's going to rebalance in a week or so. It's going to spit out stuff that's just ugly, stuff I would never actually pick on my own, right? So I don't know, last quarter we bought in airlines. We bought United Continental. I don't think I would have put my money into that. And basically, it's almost like turning your brain off and like, as an automaton, just saying, I'm following this because it's a strategy. Same thing with the magic formula. They asked Joe Greenblatt, he said, you know, and I mentioned this in the book, he said, you know, you basically, if you go to magicformula.com, he's done all the screening for you. You could go there basically and buy the top 10 stocks that rebalance every year and significantly beat the market, at least according to research. And I believe it's true. And they asked him, so well, once you publish this and you made it public, you know, won't the efficacy of the strategy sort of die away? And he said, well, it's a good question, but ultimately, people have a very hard time following a strategy like that, a quantitative strategy, where you basically turning off the qualitative part of your mind, that the sort of goal-seeking, you know, I'm going to outperform by picking stocks, and just following a formula, and it's extremely hard. So, you know, that's what this is all about. It's sort of finding these strategies, and, you know, again, there's some great behavioral finance books that come out, and again, you have to handle sort of all the animal spirits and everything like that. But there's some great tools out there that if you use them effectively and efficiently, you can make a lot of money. So I basically danced around the answer to that question. Are there any other questions? I guess I could pose a question to you. Going forward, if you guys are interested, you know, are there certain topics you'd like to that you're interested in as students or as, you know, future investors, whatever, that I can help answer or help find you experts that can answer those for you? So more the demand side than the supply side there. Any last questions? Oof. Are there any stocks that you like today that we could hear your pitch on? I'm not in the, again, so I've gotten out of that game mostly, where I own stocks in my portfolio based upon the guru strategy that I don't really know anything about, and that may sound sort of futile or ridiculous, but that's sort of more the model I'm going to. You know, you can always find really like story stocks online. I think Seeking Alpha is a very good place to do that. Okay, so let me put out the disclaimer: do not buy the stock. There was one by James Altucher, who's a fantastic writer. I don't know if you guys know him, a formula investor. He's been an investor. He's in the media everywhere now. In fact, I think at some point he'll probably launch a hedge fund. He even talked about creating a, sort of a do-it-yourself Warren Buffett hedge fund portfolio. He wrote a book about it a couple years ago. It's a poor-selling book, but he was one of the first people started talking about these ideas. He found a stock on Seeking Alpha recently called Star Scientific. Does anybody know that one? It's a tobacco company that actually does no cigarette business. Basically, it's a biotech. The story is insane. There's a huge write-up of it on Seeking Alpha. It's one of those stocks that sort of polarizes everybody. So it's a cigarette company that actually is not in the cigarette business. It actually has a patented way to cure tobacco leaf that seems to be less damaging to your stuff. And not only that, so just get this, the whole thing is ludicrous. Not only that, they sort of isolated some of the tobacco compounds, and in rats found that one of the compounds that they isolated seemed to stave off Alzheimer's. So because it's not a drug, it's sort of considered a nutraceutical. By the way, they were challenged on all these patents by, I don't know if it was Philip Morris or it was Lorillard or whatever, and actually the patents held up in court, so that adds to the mystique of the story. They then sort of got fast-tracked to human test on this compound that staves off Alzheimer's. And the person, as it even gets crazier, the person who, there's a famous doctor, or I don't know if he's a medical person, he has a center that does Alzheimer's training, testing. Met with them, decided that they'd do the human trial in his center, and he also, I think he put like $1 million of his own money into the company, and there was all kinds of insider buying and stuff like that. So I think when Altucher was one of the first guys to recognize Dendrion's potential, and he was buying it, I think, in the single digits or early teens. He said this was another stock like that. You go online, you see it, and there's some people that think it's going to the moon, other people think it's just a farce. So that's the type of stock I think that you would normally only find like within a Yahoo chat room, and we don't have the tools. The chat room stuff is still broken, right? And it's very hard to find information. Seeking Alpha sort of inverted turned the chat room inside out and provided a fantastic medium for people to do that. I don't know how many saw Whitney Tilson's short on Netflix. I'm sure you guys saw that, and I don't know if you saw that the CEO of Netflix had gone on to Seeking Alpha with a rebuttal on why Whitney Tilson's going to get his book handed to him. So, it's great that conversation is happening. You could take, aside whether a CEO should be blogging sort of a response. And not only did he blog it, he blogged it on Seeking Alpha. It wasn't that Seeking Alpha picked it up. I don't know if you guys saw that. So that's my one stock I think I would probably mention. I do own it personally. It didn't come up in any of the screens, by the way. It has no revenue, so it's one of these it's a punt. Don't buy it. Any other questions? Do we have any final questions? That's it from your end. So I appreciate your patience. I hope we didn't bore you. All the stuff's online. If people are interested in talking more offline about some of these things, I'm always available. My email's on my website, or you can hit me on Twitter. If the stuff was useful for you, I'd love to hear your feedback. And definitely thanks to Zach and to Aaron here, who's moderating the session, for putting this together. And hopefully next time I'm in LA, I can stop by. Thanks, guys.